The special release of the CPI yesterday came in lower than survey expected. And that prompted a very quick melt up, or maybe not a melt up, but a rise in the stock market as it signaled that perhaps the Fed is going to be more comfortable with rate cuts going forward. And then this prompts more people to say, well, if the Fed is going to cut rates, that is going to be inflationary, and that is going to defeat the purpose of the CPI coming down, showing disinflation, which led to then questions is what is the bigger risk? Is the bigger risk inflation? Is the bigger risk deflation? Or is stagflation the bigger risk? And so I thought what we would talk about today is why we need to think about this at all. I think there's a lot of people out there who think the Fed is just going to print no matter what, and therefore inflation is here to stay. There's nothing they can do about it. There's nothing they want to do about it. And therefore, all you have to worry about is inflation. I think that's the wrong way to think about it. And I think it's not that you shouldn't worry about inflation, and it's not that inflation has guaranteed been tamed. But what we're going to talk about today is why in the system that we have, there is always the risk of a massive deflationary move. Now, it doesn't mean it will come. It is not a guarantee, but we're going to walk through why you can't completely take it off the table, and because it is baked into the design of the system. So let me pull up some slides here and we'll just get started. So first of all, I think we need to kind of take a step back and what when we say inflation or deflation or disinflation, what are we talking about? So inflation is when prices are rising and continue to rise. Disinflation is when prices are rising, but they're not rising at the same pace that they were previously. And then you get into deflation, and that is where prices are falling and continue to fall. Based on the design of the system, we cannot have prolonged deflation without the entire system coming down. And I'm going to kind of walk through why that is. And so the fact is, the powers that be, the monetary authorities, the central banks, however you want to describe them, they do want inflation. Now, they don't want runaway inflation because that's not politically acceptable. But the design of the system necessitates at least a little bit of inflation. And that is why, over time, fiat currency loses value. But again, the big question now is what are we going to have in the years ahead? Are we going to have inflation? Are we going to have disinflation? Or are we going to have deflation? Now, there's a fourth one, which is stagflation. And I have to say, I used to hate it when people would say we're going to have stagflation because I thought it was a total cop-out. I thought it was sitting on the fence and not being willing to make a call. And I have to say, though, now, I actually think this is the environment that we're in. And I kind of take back all the bad things I said about stagflation, years ago, because I do think we're in an environment where certain things are going to slow and certain prices are going to come down. But other prices, either due to supply chain effects, due to limited supply, due to supply-demand dynamics, are going to rise in price, especially now that we have this trade war with China and we're moving into an environment where for national security interests, we need to have, things either sourced at home or sourced from friendly countries. And I think this brings up an environment where we are going to have some of both. And I don't know that we're going to have a clearly defined environment where we can clearly say whether we are in massive inflation or massive deflation. I think it's going to be a little bit more complicated than that. But what we're going to go over today is why you always have to be prepared, even if it's not your base case, why you always have to be prepared for a massive deflationary move. And the reason is, again, the design of the system itself. And now I know some people will say, well, it doesn't matter that that's in the design of the system because the Fed's going to save us. They're going to print money. You don't really need to worry about the short-term deflationary moves because it's only a matter of time before the Fed comes in and prints. And listen, this is the whole reason central banks exist in the first place. So I'm not going to disagree with that. That is the reason. I mean, that is why they're there, and that is what they will do. That is their function. That is literally their function. But unless you think they are infallible, or unless you think they are gods, unless you think they are more powerful than markets themselves, they are not necessarily always going to be there. They're not necessarily going to be there at the right time, and they may not be powerful enough, at least initially, to save you. And I'm going to walk through why that is. Essentially, what we have is a debt-based monetary system. And in this debt-based monetary system, we have a monetary base. Now, the monetary base is the only money that actually, quote unquote, exists. This is made up of currency and coins and reserves at the Federal Reserve or at the central bank. That money at the monetary base or the reserves, however you want to think of that, that money is not loaned out. You don't take the reserves and loan that out to somebody else. The monetary base is used as collateral to lend new money into existence. Now, in reality, I think M2 is around 22 trillion. Now, in this example, we're making it 16, but I just did this for an example, right? So the monetary base is 4 trillion. They lever that up. They use that as collateral, loan new money into existence. They create an additional 12 trillion, and now you've got a $16 trillion M2 or monetary or money supply, however you want to define that. But again, the 12 trillion has been loaned into existence. It doesn't actually exist other than as a result of the loan. That is important because when you loan money into existence, loans have interest attached to them. And every year or every quarter or every 6 months, whatever the terms of the deal are, interest on those loans must be paid, right? Okay. Everybody with me so far? That's fine. But if this is the entire monetary system and this is the entire money supply, where does the money come from to pay the interest that just now showed up as a result of moving forward in time? If this is all the money, where does the new money come from to pay the interest? Well, there's two places it can come from. They're both very important. And that's where these two symbols come in. Now, if you don't take anything else away from this presentation or this podcast, take away this slide. These two symbols are the two most important symbols to understand how the system works. And that is, you either need to have velocity or you need to have new supply. So you either need to have liquidity moving or you need to have new liquidity added to the system. That is because that is where the money comes from to pay the interest that gets created as a result of loaning money into existence. So, in other words, if you have $4 trillion of monetary base and you have 12 trillion loaned into existence, that 12 trillion generates interest payments that need to be paid. Since this is all the money, the only place that money can come from to pay that interest is if the money is circulating, if the velocity is money. If you pay somebody and then they take that money and they put it in the bank and they make their car payment, and then the guy that loaned you the money for the car, he takes that and he pays to buy a new car. And then whoever buys that new car goes and puts gas in it, and the gas station attendant or the gas station owner takes it and he pays his mortgage. That is velocity of money. That is money moving through the system, and that is the way one unit of currency can pay more than one unit of interest or the interest on more than one unit of money that's been loaned into existence. It's like the shark. The shark has to swim and it has to move. If it doesn't, it sinks to the bottom of the ocean and it dies. So you need velocity of money. You need movement of liquidity in a debt-based monetary system. But what happens if there is no velocity? What happens if everybody just sits on their money because they're scared or because there's a downturn or whatever reason? Well, if interest is not paid, then defaults start to happen. In defaults, money disappears. When money disappears, then credit contracts. And when credit contracts, prices fall even more. That is how you get into and if it gets bad enough, the participants will even start drawing on the reserves. And reserves can, and it would be extreme, but reserves can even start to disappear. So if that happens, that is how the whole system comes down. And we have actually gotten close to that happening a few times in the last 25 years. And I'll talk about that in a minute. But in that event, that's when the monetary authorities, the Fed, the central bank, the Treasury, or some other country's central bank has to go in and they have to increase the monetary base. So again, back here, money is disappearing, even the reserves potentially disappear. That's when the Fed comes in. They recollateralize the system. They increase the monetary base, and perhaps they even increase the monetary base enough that then that it reignites confidence. It convinces everybody that they're going to do whatever it takes. And then rather than sitting on the money, they start loaning money back into existence, and we get the system functioning again. That is how the monetary system works. That is why central banks exist. And that is why they come in when we get into one of these big downturns or one of these big credit contractions, and they do either do bailouts or do stimulus or do QE, or in some way or another, they have to recollateralize the system to get confidence back into the system so that people start loaning money into existence again, the extension of credit. The whole system is based on the extension of credit. So again, these are the two most important symbols. If you remember this, if you remember these two things, you will be ahead of 90% of the people out there, because most people have no idea how the system works. Okay, but again, why do we have to worry about this? If we know the Fed is going to come in and we know they're going to recollateralize the system, why worry? Well, part of the reason that we worry is because you have to understand when they're recollateralizing the system, don't confuse new money with more money. And what I mean by that is when they are doing QE or when they are doing stimulus or when they are doing bailouts, you have to realize there's an extreme credit contraction going on. And in that credit contraction, money is being destroyed. It's disappearing. So it's like a swimming pool that has a hole in the bottom, and the water and the money is draining out the bottom. Now, if somebody else is pouring water into the top, they have to pour water in at a higher rate than it's leaking out the bottom. And so even though they start to put new money in, it doesn't mean necessarily that there's more money or more water in the pool. If more water is leaking out of the pool than they're putting in, overall liquidity is still falling. And to get it stabilized and to get the pool filled back up, maybe it only takes a day, maybe it takes a week, maybe it takes 6 months. But in that period of time, asset prices, stock prices, other things in the economy, they start to come down. And as those prices come down, it makes it harder to lend new money into existence, because that is the collateral which is used to create new money. And so, in the last 25 years, we've seen 5 pretty big drawdowns. At the .com, we saw a 50% drawdown in asset prices. I'm just using the S&P as an example, but we could really use anything. You could use house prices, you could use car prices, you could use, commodities. There's a lot of different things that you could use to check the prices of things in these massive deflationary events. But again, the .com, we saw a 50% drawdown in the S&P 500. Again, in 2008, we saw about a 50% drawdown in the S&P 500. In COVID, we saw about a 35% drawdown. In 2022, I think we saw a 25% drawdown. And then just earlier this year, we saw a 20% drawdown. Now, in each of these episodes, even though either the central banker, something happened that provided confidence that sent things back up, in every one of these episodes, there were people that got wiped out because either they were trading on margin, or they had borrowed too much, or they couldn't meet short-term needs. Even though the bailout was going to come, it didn't come either in time, or it didn't come in the right amount, or it didn't come in the right type. And as a result, you get wiped out. And because people are getting wiped out, that is what forces the Fed to come in. If people are not getting wiped out, there's no reason for the Fed to come in. So the point is just because you know they're coming, they're not going to come until some of you get wiped out. So you can either be a victim, or my point is, if you're not ready, you can be one of the victims that is a necessary sacrifice to bring them in to save everybody else. And it's kind of understanding this that led me, we talked about this last week. If you didn't watch the show last week, I would recommend going back. And, when I kind of figured this out, in the kind of the 2008, 2006 to 2009 is when I was trying to figure all this stuff out. And I started thinking about these different types of scenarios that I could go through, or we could go through, either from full recovery to full collapse. And I realized I couldn't take any of these off the table. You can reduce the likelihood of it. And, obviously some probabilities are much higher than the other, but I couldn't completely remove any of these potential scenarios. And I realized in all of the scenarios, except for full recovery, I would want to own gold. Not because gold would necessarily perform well during this type of an economic scenario, but gold has a permanency to it, where it can't get inflated away. It can't be destroyed in a deflationary collapse. And it would have value on the other side of whatever environment this was. And so that's kind of when I decided, we need to own gold. And that's why I want to, we talked last week about gold, and we said gold had a heck of a year, and its move higher was kind of exponential, and we were expecting a pullback. And it really, just a couple of days later, we got a pretty good pullback in gold last week. I think it pulled back 8 or 9%, and then it bounced a little bit Thursday, Friday, and so now I think it's down, I don't know, 6 or 7% from the high. But gold is one of those things that I own it for different reasons than most people. I own it more for protection and for permanence and for insurance reasons. But if we go back to this slide back here again, really the only environment that I would not want to own gold would be like a full recovery. But anyway, this is the reason I'm talking about this is I want to remind everybody who watches on a regular basis probably remembers that I recently joined the advisory board for monetary metals. And the reason I'm bringing it up now is I think last week is a very good example. All year gold was very steady, just kind of up and to the right. No, not much downside at all year. And if you bought back earlier in the year and you have this pullback, it's not that big a deal. But if you just bought a week ago and now you're down 6 or 7%, you're probably wondering, when it's going to turn around. But the thing I like about monetary metals, and the reason I joined their advisory board, is most people own gold in one of two ways. Either they own the bullion, which just sits there, and that's not a problem with just sitting there, but it's very safe. It sits on the kind of the left tail of your portfolio, very safe. It's always going to be there, not much to worry about. And the other way people own gold is through the gold miners, and that sits on the right side of the portfolio. Now, the gold miners, some of them were down 10, 15, 20% over the last couple of weeks. I mean, they're up 100% for the year, but again, a pretty big drawdown over the last couple of weeks. And so it's this huge dichotomy, these two different ways to own gold. One of them is not very volatile. The other one is extremely volatile. The thing I like about monetary metals is there's a way to own gold and sit in between those two ends of the barbell. And monetary metals has a business structure where they're actually putting gold to work as money. A lot of people believe that gold is money. And I always tell people, this is your chance to kind of put your money where your mouth is, because if you believe gold is money, then you should be putting gold to work as money. And that's what they offer at Monetary Metals. I would encourage everybody to go and check it out. I have an account with them. I opened an account 2 or 3 months ago. Or a couple months ago. And, the plan is to just have the gold there, earn a yield on it. It's a way to earn yield on a gold. Again, it sits halfway in between or somewhere in between the two extremes. It's a way to earn yield on your gold, have it be productive. And also it's a way to try to bring gold back in, at least in some semblance, into the monetary system. And I think it's a great way to add another way to own gold into your portfolio. And there's studies that show if you own gold in a portfolio, it makes the Sharpe ratio better. And then if you own gold with a yield in a portfolio, it makes the Sharpe ratio even better than that. So again, I highly recommend everybody check it out. Again, monetary-metals.com/Santiago. You can go and you can sign up and you can learn a lot more about it. But anyway, back to the economic scenarios. Again, while I want to own gold in almost all of them, except for a full recovery, in all of the others, there is a level of risk. And in some cases, certain assets do well and some assets don't do well. But it really goes back to this design of the system. And it goes back to the way the system is designed. And it goes back to the fact that money is loaned into existence. And if those loans, for whatever reason, go bad, you can get a drawdown very quickly. We actually wrote about this. It's literally exactly a year ago. Last October, we put out a report. We put it out at the time under the name Macro Alchemist. We've rebranded that since to Santiago Capital Research. But we wrote about shadow banks and private markets because we felt like this was a big area of concern. It hadn't really shown up in the markets yet, but it was an area that was growing really fast. It was very opaque. There was a lot of potential issues with it, and we thought it was only a matter of time before it started to show up in a negative way in the markets. And that's exactly kind of what we've seen in the last couple of weeks. And the reason it's concerning is this market has grown incredibly. The shadow banks and the private credit has grown dramatically more than traditional bank lending over the last couple of years. And and the reason it's important is because it's more opaque. It doesn't have the same regulatory requirements. The capital ratios aren't as clear, and in many cases they're being done perhaps at yields. It's kind of a search for yield. So sometimes the yields are a little juicier on the investor side, but they're also more costly for the people borrowing. And so, I'm just going to read you a couple outtakes from this because I think it's important to understand. And basically, private equity, when you think of shadow banks or non-bank entities, they're firms that act like banks but are not really banks. And as such, again, they don't have the same regulatory oversight. They don't have the same visibility, the same transparency. But in any case, private equity firms and direct lenders have been a vital source of credit for small and medium-sized businesses and for leveraged buyouts. These areas are often considered too risky for capital intensive for traditional banks, further underscoring the growing role that non-bank financial entities play in providing essential credit where banks have become more risk averse. As non-bank financial institutions continue to expand influence and borrowing magnitude, the urgency for regulatory bodies to address their systemic risk grows before another financial crisis emerges from the shadows. And what you can see here, you can see where private credit is playing an increasing role in either buyouts and many deals. And as a result, it just raises the risk level if and when a slowdown ever comes. And this is another way to look at it. Again, moreover, the increasing use of payment in kind structures where interest payments are capitalized rather than paid in cash adds another layer of complexity. While PIK arrangements provide temporary relief to borrowers by postponing cash payments, they heighten liquidity risks for lenders, capitalizing interest rather than receiving cash. Again, the terms are often a little bit, in some cases more draconian for the borrower, but it's also open to more specific. What's the right way to say this? The terms are often non-traditional, and you get into these things where you're paying in kind and you're capitalizing interest payments rather than actually receiving cash. And again, it increases the risk, and it makes things. It shows that there's less liquidity in this market, and in some kind of a slowdown, less liquidity ends up being a problem. And the reason that's important is this is exactly what we're seeing now. So we were writing about it a year ago. It was something we were worried about. We were saying at the time, and nothing is showing up yet, but it's only a matter of time before it does. Well, now it's starting to show up. And so these private credit funds have already started over the last couple of months to start to have some bankruptcies, some drawdowns, some of this stuff that, the opaqueness and the lack of transparency is starting to show up, and these loans aren't getting paid. Defaults are starting to happen. And as a result, credit is contracting in the private credit market. And you can see these are often correlated. And while the S&P 500 has continued to rise higher, private credit is already starting to break down. If these correlations remain, what it's saying is either it's just a matter of time before private credit gets better or the S&P 500 comes down. And that's going back to that chart where I showed you the drawdowns. This is how even in an inflationary environment, or in an environment where you think inflation is higher than it should be, and even in an environment where the Fed is cutting rates, if they don't cut rates fast enough in an environment where private credit is contracting and new credit is not being extended, you can get a drawdown that comes out of the blue, and it can get very fast. And then when you combine that with the effects of the concentration of the equity markets in a handful of stocks, and you get the effects of passive management, this is how a 10, 20, 30% drawdown can come out of the blue when you're not ready for it. And it's why you should always be ready for it, even if you don't think we're in that type of an environment. Now, it doesn't mean you need to sell everything. It doesn't mean you need to short the market. It just means you need to be aware that this can happen and why it can happen. And you're starting to slowly see this show up in the regional banks and even some of the larger banks. Now, if you look at this chart, you can see that in the last couple of weeks, they've started to roll over. But earlier in this year, you can see, when we had the tariff tantrum or whatever, you can see how quickly the drawdown happened. Or go back, 2 years ago in 2022, when we had what was it, Silicon Valley Bank and First Republic Bank. You can see how quickly that drawdown occurred, because this is what happens when loans start defaulting and credit starts to contract. And you can see how go back to 2020 during COVID. You can see how quickly you can go from everything being fine to no liquidity in literally just a few days or a few weeks. And so again, there's no guarantee this happens again right now, but some of the signs are there. This is a great chart that my friend Mike Green at Simplify Asset Management made, and I think it's kind of a pretty unique observation here. And what he is showing is it's basically bankruptcies versus credit spreads. And if you look back pre-global financial crisis, credit spreads were coming down and getting lower, even though bankruptcies were already starting to rise. And what's interesting is we're seeing the same thing again now. The gray line is bankruptcies starting to increase, but credit spreads are actually lower. Part of the reason credit spreads are lower is there's not new supply being created of issuance, and so there's more demand for the issuance that does exist, and that is pulling credit spreads tighter. But it doesn't necessarily reflect a lack of risk as much as it is a lack of supply. And when this turns, it can turn very quickly. It gets back to, don't confuse new money being created by some kind of a stimulus plan or lowering of interest rates by the Fed versus old money that's being destroyed as a result of a credit contraction. You kind of need to understand how money can disappear really, really quickly in this type of an environment and in this type of a debt-based monetary system. And again, we just, I'm just going to put this up again, because I think it shows in every one of these events, even though it eventually worked out, if you didn't have staying power, if you weren't prepared for it, and you became one of the sacrificial lambs that then brought the Fed in to recollateralize the system, you didn't survive to see the subsequent rise. And so the whole point of this is to make sure you're aware so that you're not a victim and you can enjoy the subsequent rise. I hope that makes sense. In any case, if you like kind of what we talked about today, this is kind of the stuff that we provide at Santiago Capital Research. Again, I referenced this report that we put out a year ago on private credit. A lot of that stuff is starting to show up in the markets now. You can go to research.santiagocapital.com and check all our work out there. In any case, that's it for this week. I hope you guys all had a good weekend, and we'll catch up with you a week from now. Thanks.